I've been helping people fix their credit and buy homes for over 7 years now. I've reviewed thousands of credit reports and worked with hundreds of clients. And there's one mistake I see over and over again that has nothing to do with credit scores and everything to do with commitment. In this video, I'm going to show you the exact step most first-time buyers skip that can delay their home purchase by years and how you can avoid it starting today. If you follow this plan, you won't just buy a house, you'll keep it without being house poor. So it's not fixing your credit, it's fixing your mindset. Most people treat buying a house like a math problem, but it's actually a behavioral one. You can't build a future while you chasing trends. It's like they say, saving is hard, but being broke is harder. We live in an age of social media where you're constantly being told to buy, to, keep up with the trends, keep up with the Joneses and all that good stuff. But you got to decide, do you want the new clothes and the $500 weekends, or do you want the keys to your own property? You got to stop trying to fix ugly with your finances later and start building the habit now. So one thing you can do, I've seen this out there, is you can adopt a 2-account strategy. So just like saving $20 a shift created a habit for others, without them even noticing it, you need to separate your savings from your spending immediately, ASAP. If you don't separate that money physically, you will spend it mentally. So you got to stop obsessing over the score and start obsessing over your audit. You can have a 720 credit score and still get denied. And that's because the lender looks at your entire profile, not just a number. So underwriting is where the real approval happens. You might be pre-approved by a computer, but an underwriter is going to call your job and verify your employment stability. Lenders generally need to see 2 years of consistent employment and tax returns. If you're self-employed or rely on commissions, that 720 score means nothing if you can't show 2 years of tax returns proving that the income is stable. And don't just look at Credit Karma. Pull your actual credit report, get your FICO scores, and look for delinquent debt or collections, because those can stop a mortgage dead in its tracks regardless of your score. Next thing you want to do is calculate your debt to income ratio before you look at a single house. This determines your buying power way more than your interest rate. Banks look at your gross monthly debt divided by your gross income. Ideally, you want this total number, including your future mortgage, to be under 36%. So let's say you have a $500 a month car payment. In the eyes of a lender, that $500 obligation reduces your home purchasing power by nearly $100,000 in some markets. You might be approved for a $500K home instead of a $700K home just because of the car note. So before you apply, use the avalanche method to kill the high interest consumer debt first. It clears your DTI faster so that you can walk into the bank with leverage. A lender tells you what you can borrow, but only your budget tells you what you can afford. I see clients who get approved for $400,000, but they have $1,500 a month in daycare costs, for example, that the lender don't even see. So if you buy based on the bank's number, you'll be house poor immediately. So what you want to do is do a 3-month look back, print out your bank statements, highlight every expense, find your baseline. All right, find the baseline that works for you, the bare minimum that you need to survive. You're going to keep your housing payment, your principal, interest, taxes, insurance, all of that around 25 to 30% of your net income. If you don't run these numbers yourself, then you're letting a salesperson decide your financial future. Imagine finding the perfect home. It has the yard, the kitchen, the space you need. You put in the offer, you start picturing your furniture inside, and then the underwriter calls. They found a car payment that you didn't account for, or a gap in employment that you didn't explain, and just like that, the deal falls apart. And you're back to scrolling on Zillow with anxiety, frustration, all of those things. And you're just watching prices go up while you sit on the sidelines. Now think about the opposite. You walk into the lender's office and you fully prepared. You've already audited your own debt to income. Your down payment is sitting in a separate account because you built that habit months ago. You aren't just hoping for a yes, but you know for a fact that you're going to get approved because you did the work that 99% of buyers skip. You sign the papers, get the keys, and then you can sleep well at night knowing that you can actually afford the roof over your head. And the one question I want to ask is what is it that makes us not be disciplined or have a major life milestone that we want to accomplish, but we don't want to be completely locked in on that goal? What is it that makes us, at the drop of a dime, a friend call and say, hey, let's go out tonight, or let's go out to eat, let's do this? Listen, you got to be willing to make all the sacrifices necessary. And if it's not contributing to your goal, then you don't partake in it. Keep in mind, this is not forever. This could be a 3 months, 6 months, 9 months, even if it's 12 to 15 months. Just sacrifice for that time so that you can reach a goal. Homeownership isn't just about the credit score. It's about the commitment. It's about the discipline, and you got to be financially aligned. So if you want to stop guessing and start building that roadmap, I put together a step-by-step guide in our free credit group. So all you got to do is click the link below to join us. We'll break down the budget, the debt to income. We'll give you underwriting secrets, everything that you need so that you don't have to do this alone. Don't let a lack of planning keep you renting for another year. So click the link and I'll see you inside.